Welcome back to Alpha Recap, your weekend briefing from stockalpha.ai. Markets had closed for the day, and today we're unpacking the big themes from our weekly research. AI and biotech led the charge. SaaS showed momentum but with data gaps, and valuations created cross-asset tension. As always, if you have questions, you can reach us at stockalpha.ai and use our Q&A feature. Ready to dig in?
Thanks. Glad to be here. There was a lot to cover this week, and we tracked two big structural stories, plus a bunch of momentum-only moves that are worth parsing carefully.
Okay, quick roadmap. First, two structural winners, AI compute and biopharma innovation. Second, several software names showed price momentum, but the dataset was missing key financials. Third, valuations are high across leaders, and catalysts will probably drive near-term action. Sound right?
Yep. That sums it up. AI and biotech were the dominant narratives, but the research repeatedly flagged information gaps in a subset of SaaS names, and that creates a classic momentum without conviction dynamic.
Let's walk through the notable names. Start with the SaaS group where the data gaps were most obvious. Splunk, Okta, Twilio, Bill.com, DocuSign.
Right. With Splunk, the brief was neutral. The note said the dataset lacked public financial and industry detail, so near-term moves were expected to be news and sentiment-driven rather than fundamentals-driven. In short, wait for clearer quarterly reporting or company disclosures before forming a conviction.
So momentum, but not much to hang a thesis on.
Exactly. Twilio and Bill.com both showed small bounces into the long weekend. Twilio was up about 3.5%, and Bill.com was up about 5.5%. But the research flagged missing core metrics. Same with DocuSign, which actually spiked roughly 7% into the close. The problem? We didn't have the underlying revenue and margin detail in the dataset to test sustainability.
Which makes any price move feel like speed without a map. Right.
Yeah, that tracks. The research stance across those names was uniformly neutral. Tactical momentum balanced against elevated information risk.
Okta stands out from a valuation perspective. The notes pointed to a lofty trailing price-to-earnings ratio, nearly 100, tied to expectations about margin expansion and cross-sell. That felt, honestly, eye-popping.
Honestly, I was a bit surprised by this one. The thesis is that Okta is a leader in identity management with secular tailwinds from zero trust adoption, but that trailing price-to-earnings ratio assumes persistent margin improvement. If margins or cross-sell stumble, the valuation looks very tenuous.
Short reaction? Wow. Right. Now switching gears to the structural winners, Vertex and NVIDIA. Those two were framed as concentration risk examples. Big upside if execution holds, but premium multiples make them sensitive. Tell us Vertex first.
Vertex was a standout this week. The big news was a gene therapy FDA approval and the Crinetics acquisition. Those catalysts prompted analysts to raise targets. The research noted a forward price-to-earnings ratio of about 24 and positioned the note as bullish, but explicitly conditional. In plain language, the upside hinges on successful commercialization of the new therapy and smooth M&A integration.
So bullish, but only if the commercialization math shows up. Got it.
Yes. The research flagged the need for early commercial metrics, uptake, pricing, payer acceptance, and also early signs that the Crinetics deal is additive rather than distracting.
And NVIDIA?
NVIDIA was framed as central to the AI compute story. The research highlighted new joint initiatives with a major academic partner and a packaging partnership that could help with supply chain resilience over time. The note took a constructive or bullish tone, noting that demand in data center GPUs drives revenue and earnings momentum. But it also cautioned that the premium valuation requires sustained demand.
So partnerships as risk reducers, not just upside levers. Interesting angle.
Exactly. Framing those deals as ways to reduce supply chain and geopolitical risk was a bit of a contrarian emphasis compared with the usual demand-focused narratives.
Let's hit medtech and healthcare quickly. Intuitive Surgical, Danaher, Eli Lilly were all featured.
Right. Intuitive Surgical, structurally attractive because of a big installed base and recurring consumables, but recent share weakness left the note mixed. The question is whether procedure growth and instrument attach rates accelerate enough to justify current multiples. Danaher was neutral. Recurring consumables and an installed base are strengths, but margin pressure and a cautious revenue guide were notable. For Eli Lilly, the brief was bullish, reflecting strong cash flow and product mix, but analysts flagged policy and payer risk as real downside sensitivity.
So durable revenue streams help, but margins and guidance still bite. Short reaction, not bulletproof.
Right. Durable does not mean immune. And that was a recurring theme across the research.
Let's pause and reflect on cross-article patterns. What common thread stood out?
3 big patterns. 1. Pervasive information gaps, especially in several SaaS names, which pushed analysts to treat upcoming earnings or filings as the primary catalysts. 2. Valuation tension. Firms with clear structural narratives were trading at premium multiples, and that increases sensitivity to execution. 3. Catalysts clustered around regulatory approvals, earnings, and partnerships. Those 3 together create a bifurcated market: event-driven, high-conviction trades versus higher-risk momentum trades.
Makes sense. Now, methodology. How did the research team handle the missing data?
When fundamentals weren't available, analysts leaned on observable market signals: price moves into the weekend, analyst target changes, and a handful of valuation multiples. They also recommended prioritizing ingestion of company filings so that missing revenue, cash flow, and margin metrics could be captured next week.
Okay, time for the agenda. What are the top next steps for the research team?
High priority: get full earnings and guidance surveillance for Splunk, Twilio, DocuSign, and Bill.com to fill in missing filings. Also high priority: monitor Vertex commercialization and Crinetics integration metrics, and map NVIDIA's ecosystem and supply chain impact from its partnerships. Medium priorities include reassessing Okta's addressable market and margin levers, and digging into procedure-level telemetry for Intuitive Surgical and Danaher. And ongoing: a data completeness drive to standardize core metrics across all briefs.
Short reaction. Sounds like a lot, but necessary.
Yep, and the team suggested some methodological upgrades too, like standardizing core metric capture and blending event and fundamentals frameworks where datasets are thin.
Before we wrap, quick contrasts and contrarian takes that jumped out?
2 contrarian notes. 1. Vertex got a bullish label despite a premium forward price-to-earnings ratio because the approval and acquisition create tangible near-term upside. 2. The NVIDIA note framed partnerships as risk reduction, which is a less common angle compared with pure demand narratives. And finally, several notes expressed skepticism about momentum without transparency, a conservative stance that contrasted with market chatter chasing price action.
Great. A few quick practical takeaways for listeners?
First, treat momentum in SaaS with caution until the missing financials show up. Upcoming earnings will be catalytic. Second, for premium, catalyst-driven names, model multiple scenarios with explicit triggers. Commercialization and margin expansion are key. Third, durable revenue streams in healthcare help, but margin and guidance risks can still compress multiples quickly. And finally, expect near-term volatility around earnings, regulatory milestones, and M&A integration outcomes.
Short reaction, clear and actionable framing. Right.
One last point on language. The research stuck to objective phrasing. Analysts note, data suggests, momentum indicates. It's not investment advice. The report was explicit that it didn't recommend buying, selling, or holding any specific security, and that readers should consult their own advisors.
Perfect. Final wrap-up, 3-sentence sign-off.
This week showed a bifurcated market, concentrated structural winners in AI and biotech, and a set of SaaS names where price moves outpaced available data. Analysts recommended prioritizing filings and early commercial metrics to convert momentum into fundamentals-based views. Keep an eye on earnings, regulatory milestones, and partnership timelines as the primary near-term drivers.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. And thanks for listening to Alpha Recap. Catch you next week.